Is the stock market's latest, darling, a fundamentally misunderstood, undervalued gem just on the verge of this massive AI revolution?
Or is it, and we see this all the time, is it just a classic value trap designed to catch overly eager retail traders?
Right, exactly. So today we are diving deep into Navitas Semiconductor Corp. Ticker is NVTS. And as of today, April 20th, 2026, the stock is trading at $13.20.
Which is wild, by the way.
It is. It's up an astonishing 73% year to date. So for everyone listening, whether you are actively trading this or just, fascinated by the wild swings of this whole AI hardware boom, we're going to unpack the mechanics here.
Yeah, because understanding what's driving this specific stock, it reveals a whole lot about current market psychology.
It really does. So our mission today is basically to separate the hype from the reality. We've got a massive stack of financial reports, technical analysis, insider trading data, the works.
We have a lot of contradictory signals to sift through, that's for sure.
Oh, totally. So before jumping into the absolute frenzy of the current stock price, let's look under the hood at the company's actual financial health.
Yeah, let's do a little reality check on the fundamentals. Because if you synthesize the full year 2025 financials, it is a really stark contrast to that 73% stock rally.
Right. The numbers are, well, they're not great.
Not great is an understatement. Total revenue dropped 44.88% year over year. They brought in just $45.92 million.
Wow. Dropping almost half your revenue in a single year.
Yeah. And it gets worse. They posted a staggering net income loss of negative $116.95 million.
Wait, really? $116 million in losses on just $45 million in revenue.
Exactly. Which brings their EPS, their earnings per share, down to a negative 57 cents.
Okay, let's unpack this for a second because I was looking at their cash situation. It paints a weird picture. Navitas has $236.9 million in cash right now.
Which sounds great on paper, right?
Right. But it was heavily bolstered by a $95.6 million private placement in late 2025.
Yeah.
So, it sounds like they're basically burning the furniture to keep the house warm at this point.
That is a perfect analogy.
Because with an operating cash flow of negative $42.89 million, are they just, buying time to pivot their business model?
They absolutely are. They are in the super messy transition phase right now. If you look ahead to their Q1 2026 outlook, revenue is expected to rise just a tiny bit to somewhere between 8 and 8.5 million.
Which is still incredibly low.
Yeah, and with a 38.7% margin. So fundamentally, the business is bleeding.
Okay, so this is where I want to pivot the conversation. Because if the fundamentals are currently bleeding out, the stock chart is doing the exact opposite.
It's doing its own thing entirely.
Yeah. Why is the stock moving like this right now? If the business is struggling, why the 73% pump?
Well, let's break down the technicals. On the daily chart, NVTS is in a highly, highly bullish trend.
The algos are loving it.
Oh, they are feeding on it. It's trading way above its 20-day moving average, which is at 9.65. It's above the 50-day at 9.25, and it's well above the critical 200-day moving average of 9.47.
So it's basically breaking out across every major time frame.
Exactly. Just in the past 2 weeks alone, momentum pushed it up 49.41%.
That is insane. But with these charts, what's the catch here? Because nothing goes up in a straight line forever.
Right. There are some pretty severe warning signs flashing right now. We're seeing major short-term weakness under the hood. For one, the RSI, the Relative Strength Index, is sitting at 74.07.
So it's officially flashing an overbought signal.
Yeah, technically very overbought. And furthermore, if you look at the last trading day, the volume actually fell by 5 million shares.
Even though the price went up.
Exactly. Despite a 7.14% price bump on the day, the volume dropped off a cliff.
Okay, here's where it gets really interesting for you listening. The price went up, but the crowd actually got smaller. That price volume divergence is a classic warning sign of a short-term pause, right?
It is a textbook bearish divergence. The buyers are exhausted. And when that momentum snaps, the key support levels are all the way down at 11.33, and then below that, 11.05.
That's a steep drop from 1320. So who is actually driving this price action if the volume is starting to thin out?
It's retail. The order flow data shows this is a massive retail pump. If you look at StockTwits, the message volume for the NVTS ticker has exploded by over 3,600%.
Oh, wow. So it's just pure message board hype at this point.
Hype and likely a lot of short covering. The shorts are getting squeezed by retail, which pushes the price up to that immediate resistance level we are seeing around 13.42.
So if retail traders are buying the stock hand over fist, it begs a pretty crucial question. What are the insiders and the Wall Street whales actually doing with their shares?
Well, get ready for a major red flag.
Uh-oh.
Yeah, insiders are extremely bearish. Over $34 million in shares have been sold by executives in just the last 6 months.
Wait, 34 million, that's not just like standard tax selling.
No, it's not. This includes the CEO, Chris Alexander, and the former CFO, Todd Glickman. They have been dumping shares. And crucially, there have been absolutely zero open market purchases by insiders recently.
Zero.
Yeah.
Wow. So the people running the company aren't buying their own stock. But wait, I was looking at the institutional filings, and it looks like some massive funds are actually accumulating shares, right?
Yes. And that is the massive contradiction here. Just as it looks like a clear-cut retail trap, you look at the institutional side, and they are super bullish.
Who's buying?
In the fourth quarter of 2025, Davidson Kempner accumulated 9.6 million shares, and Invesco stepped in and bought 3.4 million.
Wait, so let me get this straight. The captain of the ship is essentially selling his own lifeboats, but these massive luxury cruise lines are trying to buy the whole ship.
That is a great way to put it.
What does this all mean? How do we explain this massive disconnect between the executives and Wall Street?
It really comes down to how Wall Street analysts and these big funds are modeling the risk. Right now, the analyst consensus is a hold, but the average price target is grim.
How grim?
The average target is 6.78.
Oh, wow. So from 1320 today, that represents what? Almost a 48% downside risk.
Exactly. Deutsche Bank even has a low target of 3.50, though, to be fair, Needham is holding a high target of $13.
Okay, so the valuation debate is literally all over the map.
Totally. At a $3.05 billion market cap, Simply Walsant claims NVTS is about 25.9% overvalued. And if you run Peter-led models, which actually rely on earnings, the fair value is much, much lower.
Right, because there are no earnings.
Exactly. Total lack of earnings.
So why might retail traders be stepping into a massive trap here? Let's talk about the downside risks.
The biggest risk is the collapse of their old business. Navitas' legacy mobile revenue, the phone chargers, and consumer electronic stuff, it crashed.
That used to be their main thing, right?
It was. It went from being the vast majority of their income to less than 25% in just a single year.
That is brutal.
Yeah, and you combine that collapsing legacy business with massive cash burn and intense competition from larger, established players in the space.
You mean in the Gannon-Sickie space? The gallium nitride and silicon carbide stuff?
Exactly. The big legacy semiconductor companies are moving into that space. Yeah. And Navitas is bleeding cash trying to compete, so the downside risk is incredibly severe if they fail.
Okay, I have to play devil's advocate here then.
Go for it.
If it's such a clear trap, revenue is down, cash burn is high, insiders are selling why the 73% surge year to date. What are the retail traders and these massive institutions like Invesco actually betting their money on?
They are betting on Navitas 2.0. They're betting on the AI savior.
The AI savior. Okay, explain that.
The core of this extremely bullish sentiment comes from the hype surrounding Navitas' collaboration at the NVIDIA GTC 2026 conference.
Okay. Anytime you attach the name NVIDIA to a ticker right now, it just goes crazy.
Pretty much. But it's specifically regarding their 800-volt to 6-volt boards.
Right, their step-down power boards.
Yes. The company is aggressively moving toward AI data center infrastructure. And this isn't just like a minor pivot. It's an attempt to capture a slice of what is projected to be a $3.5 billion opportunity by 2027.
So they are trying to provide the power architecture for the next generation of AI servers. Because from what I understand, these new AI chips run so incredibly hot and they need so much power that traditional silicon power supplies just melt.
Exactly. You can't just plug these massive AI clusters into legacy power systems. You need gallium nitride and silicon carbide to step that voltage down efficiently without creating too much heat.
And that's what Navitas is building.
Right. And why it matters to the institutions is that if Navitas actually pulls this off, if they become the standard for these new data centers, then the current $3 billion market cap might actually be severely undervalued.
Wow. So that's the bull case. If they secure the AI data center market, $13 a share is a steal.
A total steal. But if they fail or if they run out of cash before they get there, the stock crashes.
Okay, so bringing this all together for the short-term reality for you listening, prepare for some extreme volatility in the coming weeks. We are leading right up to the May 5th, 2026 earnings call.
That call is going to be make or break.
It really is. And the technicals, like we talked about with that RSI divergence, they suggest a likely pullback toward the $11 support level before we even get there.
Yeah, the big picture here is that Navitas represents the absolute classic high-risk, high-reward bet in the tech sector.
Yeah, it's a company enduring incredibly painful operational losses, just burning cash, to fundamentally rewrite its entire DNA for the AI era.
Exactly. They are betting the whole company on this AI pivot.
Which leaves us with a really provocative final thought to mull over.
Let's hear it.
When you see retail traders completely at odds with Wall Street price targets, oh, wait, let me rephrase that. When you see retail traders so incredibly bullish, but the actual company founders are selling their stock, while at the exact same time, major institutions are buying it up, who is actually the smart money here?
That is the ultimate question.
Right. I mean, are everyday retail investors correctly front-running this massive AI infrastructure revolution? Or are they simply serving as the exit liquidity for executives who are just cashing out?
Honestly, it could go either way at this point.
It really could. So keep a very close eye on that May 5th earnings call to see which side of this tug-of-war finally snaps.
It's going to be wild to watch.
Definitely. Thanks for joining us on this deep dive.